I have never been more convinced that we are going to have some form of housing bubble burst, crisis, crash, correction, call it what you will. Stuff is starting to line up now. More and more people are chiming in. A lot more information out there, guys. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today is the 3rd of May. We are into a new month. Hope everyone's doing well. Lots to talk about. And again, every day it's a new thing in housing, right? This video is brought to you by our friends at Foreclosure.com. So if you'd like to find out more information as to what's going on in your neck of the woods, go to gethousingdata.com. Gethousingdata.com. That's going to take you, it's my affiliate link. It's going to take you to foreclosure.com. You can check out what's going on in your area. Foreclosure.com is the #1 provider and listing services of distressed properties in the nation. So gethousingdata.com. Please check it out. Okay, so one more thing too, little ad promo here. The first call for my I guess you say distressed property architect program will be Thursday, 8 p.m. Eastern Standard Time. If you are subscribed and you're in the program, I'll be sending you an email tomorrow with the teleconference bridge. I guess you could say, call number and the pin to get in. I'm going to record that, so don't worry if you can't make it. I'll record it. I'll put it back into the system afterwards. So still time to get in. Who's this program for? It's for home buyers, people who want to buy or purchase a home at a cheaper rate. Investors, if you're learning to invest, you want to take a look at the distressed properties, all the opportunities there. Real estate agents, you know what? It's tough being an agent right now in the field, isn't it? Well, guess what? No one's going after these properties. So something you can specialize in. So we're going to talk about foreclosure, auctions, REOs, pre-foreclosure short sales, tax deeds, probate, estate, subject to the mortgage, so taking the property subject to the mortgage, a little different concept there, vacant land, built to rent, built to flip, and Airbnb, plus a lot of other things I got in there, be very beneficial. We're going to tell it like it is. We're going to give you the nitty gritty and talk about stuff that I don't really talk about on this channel for kind of obvious reasons. So guys, you know what? I reached out to a lot of people. Just jump on board, connect with me, give me your phone number so I can connect with you, okay, if you send me an email. All right, guys. I pride myself on, listen, I like to look at the statistics, look at the information, see what's going on the news wires and the internet, but also really getting a pulse as to what's going on in the industry. So what I call that is local intel in the field, feet on the street, all right? And that's really a lot of where I get my gut feel as to what's going to happen in the marketplace based on what I hear going on in my own market across the country, etc., from other real estate professionals, agents, lawyers, investor buyers, the whole, economists, analysts, the whole bit. So I talk to a lot of people, get a lot of sort of, intel that way, and can kind of formulate some good opinions. I'm going to talk about something, and so hang on to the end of towards the end, because I've got an article which I think is probably the best article I've ever seen written about today's housing market. And I really resonate with it. And I think this guy's spot on as to what he's saying. So I think it's very interesting as to what's going to happen here. So the other day being yesterday, I was at a seminar event, and it's a real estate club local here in Tampa. If you're in the area, let me know. I can tell you how to join and get invited and check out stuff that we're always talking about here. So there was a foreclosure attorney who was actually speaking there at the event, and he was the keynote speaker. Now, the difference is that, I'm a short sale guy, so I'm pre-foreclosure, doing deals so it doesn't go into foreclosure. So I have an attorney that I work with in that capacity. This person is an attorney for the plaintiff. So he's processed over 20,000 cases over the years, and he's a plaintiff attorney, so he's representing the bank or the lender, not the homeowner. He's going after the homeowner. His clients are going after the homeowner for his clients. So I just think it's interesting that we got a great perspective now as to what was happening on his side of the fence. So it was very interesting. So right now, he sees significant activity right now. In other words, everything is moving forward. It's picking up the pace dramatically. What he's seen is restarts for existing cases. He's seen new filings pick up as well too. His expectation is that it's growing every month, and we're going to see major volume shortly. And this is going to go on for a number of years, based on different, states and how they process their foreclosures and stuff like that. This is not a 6-month process here. This is going to go on for 2, 3, 4 years, and we're picking the steam up right now. So this is the opportunity that I've always talked about, and that's will be presented before us. Now, one thing I do want to point out too is that I've never wavered from my discussions here, which is interesting because since I had this channel going, I've always been bullish on the fact that we're going to have problems. Obviously, it's just taking us a little while to get there via market manipulation and controlling by other people, etc. But we're getting there, okay? It's actually happening. It's starting to unravel. It'll be here shortly, okay? Now, from my perspective, yes, I'm seeing much more foreclosure activity. We see auctions that are increasing, number of auctions being set or scheduled for foreclosures, restarts of existing cases, all right? Older cases are set for sale. I'm going to show you an example in a second here. You're going to laugh at this. This goes to show what goes on and what's happening in our marketplace, and obviously an increase in new foreclosure filings. This is all happening now. So the market is changing. It's not here yet to affect market pricing right now, but it's coming. The volume is slowly building. We just have to maintain our patience, but you can still go and get these deals now if you really want to get your hands on them. So I want to show you a case here. So I picked this off the internet, and we've actually spoken to this person who's in this home. So I'm not going to name who he is, but ultimately what this boils down to is the fact that this is a potential short sale. And, I had a chance to speak with the seller. This came to me via somebody who's in our short sale program. So they're actively marketing and talking to homeowners who are in these situations. So ultimately, in the end, you've got a situation where this is final judgment. So in Florida, ultimately what happens is when you go through the foreclosure process, you get to something called final judgment, which is they award the judgment to the plaintiff, which is the banker lender, and they set the sale date from there. Now, a lot of people, if they can fight this along the way. They can hire attorneys. They can do different things. They can try loan modifications. They can declare bankruptcy. They can do a lot of things to stop foreclosure sales or push the process out and extend the time into as far as they can in their home without paying. So a lot of people do that, and they actually get quite skilled at it because they can maintain residency without paying the mortgage or taxes or insurance or anything on the property for a number of years. So ultimately, in the end here, this person was initially the foreclosure filing was back in 2007 or 8. So they've been in this property for quite some time, and they kind of filed. They got a foreclosure filing, then they did a loan mod, and then it refiled again, and they eventually went to what's called final judgment. So ultimately, this you can take a look at the numbers here. I don't know if you can see the bottom. It says the final judgment is the number that is owed to the lender as a final payoff. All right, that's everything all in costs, fees, etc. So the principal that was due on the note is $348,000. The interest from when they calculated it to the final judgment day, which is, again, it's funny because the final judgment was granted back in 2017, 18 here. So we're talking 4 years ago basically. So the interest from the non-payments is 133. And then if you look at the next page here, and I'm doing this as an example of what goes on in our industry. Okay, so look, you've obviously got real estate taxes that haven't been paid for a bunch of years. You've got hazard insurance that hasn't been paid for a bunch of years. You've got flood insurance because it's a waterfront property that hasn't been close to in a flood zone, hasn't been paid for a bunch of years. And you got a couple other charges here, maybe some some moving back and forth, some overages, whatever. But in the end, the final judgment amount was $644,000. This is back in 2018. So that's what actually appears on the auction calendar because there's no other documents in the clerk or they can pick off that shows an amended amount. So this is the number from 2018. So that was the final judgment then. So of course the homeowner was able to pull some more tricks out of his bag and actually spend his time in the property. And now it's kind of coming to an end. They're going to be setting a sale date, or I think they have a sale date set for end of this month, I believe. So 644 was the number of the final judgment 4 years ago. Well, I thought, hey, let's figure out what is the final judgment amount today. So if we fast forward to today, basically, we're not done yet. So we have to add about 5 years of hazard and flood insurance, about $34,000. Another 5 years of unpaid property tax, about $29,500. I added the 4 years of interest because there's a daily rate. So essentially, I went, it's 4 years and a few months, $107,000 of interest. Now we're at $815,143. So if he wanted to sell the property today to somebody, and he could sell it for $815,000. Now, is there equity in that property? Could he sell it? Well, guess what? What do you think? I'm going to show you this. So this is the easiest way to show you is this is Zillow. So that's what the property is. It's a 3-bedroom, 2-bathroom, 1,889 square feet in the Hialeah, Miami area. And the Zestimate right in the middle is 657. So the range is 618 to 697. So really, he owes 815 all in as a final judgment. So guess what? He can't sell that property. You know what I mean? He can't sell the property in today's market because today's market shows, at peak it's going to be worth just under $700,000. We know from talking to him that there's going to be, cosmetic work, probably, 40, 50 grand worth of cosmetic work to clean it up and get it up to a standard that will be livable and acceptable. So you got to add that into the cost profile here. So, would you pay $815,000 plus an extra 50 grand to fix it on a property that's worth $697,000 tops? Probably not. At the peak of the market where we're potentially tipping and going the other way, you probably wouldn't. So this is a classic short sale. So this is an example of, sort of busting the housing narrative when people say, oh, guess what? There's all this equity there and all these people can just sell their home and walk away with equity and, stop the foreclosures and move on. Well, guess what? No, they can't. And there's more and more people just like this, that they've gone so far behind and they don't have the cash flow to fix the property, so the property needs work, etc. So the numbers just kind of snowball very quickly. But it's an example that, why I'm bullish about where the market's headed, because now the lenders are going, the banks and lenders are going, we've had enough. Okay, we're setting up everything now to start the process of getting these deals back here, and they're going back to all these old legacy deals. Like I've seen stuff that's been, people been in the property since 2006, tons of them. So what I'm seeing now is suddenly these people they've had the sale dates set, they've been canceled for various reasons, motions, filings, bankruptcy, loan mods, whatever. Well, now guess what? The lender's going, well, no activity here, reset it. Okay, crap, reset it 60 days out, 30 days out. Now that the person has to do something. So they're concerned they got to buy more time. But it just goes to show you that it's kind of like the free rides are over now. Everyone's getting tired of it. Lenders are getting tired of holding these properties. Look what they've done. They've literally had to pay, how many years worth of insurance, like hazard insurance, flood insurance, property taxes, because this owner hasn't paid it. So they've put so much money out. In the end, they're going to lose. Simple as that. So it's like, let's clean up the mess, get rid of our losses, make money where we can, and go forward. So there is a lot of these properties out there, and a lot of these properties are still hanging around from the previous housing crisis. And that's kind of the almost humorous part of this. So that, did we recover? Not too sure. The recovery we went through was a managed recovery, and I can talk about that in future videos because, what the government didn't allow and the lenders didn't allow was all the distressed property to come back in the market to keep the market prices lower. It controlled the property, kept it off market for a number of years, allowed hedge funds to buy it. They could buy it, rent it out, do what they want with it, but people like you and I didn't have access to that, and therefore they were able to create the market recovery as to where we are right now with some manipulation and basically choking off the volume that was available from the first housing crisis, let alone where we are right now. So, by the way, guys, if you're not a subscriber and you appreciate the information in my videos, if you could smash that subscribe button, I'd really appreciate that. And if you are a subscriber, if you could just double check and resubscribe, because I always lose subscribers more than I put on. I just maintain the same level. So please do that. I really appreciate your patronage. Thank you very much. All right, guys, let's go. Now we're going to go look at some other information here. So we're in a historically overvalued housing market, and these cities could see home prices drop 10%. So basically, Moody's Analytics puts out some information, basically, saying we're overvalued. Okay, housing market enters uncharted waters. Housing inventories are in crisis mode. Mortgage rates keep spiking, freaking out an already anxious housing market. Banks are offering bigger loans than ever to keep up with the housing crisis, right? So the banks have to keep increasing their loan values or their loan amounts to homeowners, which allows homeowners to basically choke themselves out. An economic shock just hit the housing market with these new interest rates and what's going on. But the problem we're seeing is values. Home values are overvalued. So here's a chart, and I'll put the link to this article. It's Fortune magazine. So this is an interactive map, so you can run your mouse cursor over the locations. It's going to tell you based on the color and the location and where the overvalued is. So we've got a few locations that are actually undervalued, going all the way up to 73% overvalued. Okay, so obviously the darker purple and blue coloring is the more overvalued the location, you can see kind of where that's at across the board. So obviously a lot of the nicer West Coast areas, southern locations are getting overvalued really quickly. But this is interesting coming from Fortune, because normally they don't talk about this. They're more woke, supposedly. But they're really getting involved in the housing market stuff now here, so I'm appreciating their articles a little more. Basically, what they're saying here is the firm Moody's aimed to find out whether local income levels could support local home prices. The findings of the 392 metropolitan statistical areas it looked at, 96% are overvalued. So the overvalue is compared to wages to house prices, right? And income levels, wages to house prices. So we all know that over the years, guess what? Wage increases have not kept up with home price appreciation. That's a very obvious fact, yet people tend to ignore that, saying, oh, it's still affordable for people. Well, it's affordable when we have artificially low interest rates, and we allow people to get in with 3.5% down mortgages. That's where the affordability happens, raised debt to income, DTI, debt to income ratio levels, and things like that. So that's how it becomes affordable. Now we're moving away from that. Among those markets, the 392 markets, 149 are overvalued by at least 25%. That's a pretty significant amount. And the most overvalued being Boise, Idaho, where home prices are 73% above what fundamentals would support. So there you go. That's how they look at it. So that's interesting. So there's, you can take a look at that yourself. Now, this is the article I was talking about that I think is really, really interesting. I'm going to put a link to it in the information section of the video because I really think you should look at it. It's a long article. I'm just taking some pieces out of it, so I don't want to, mislead people with what I'm extrapolating from the information here. But I think this is probably one of the best articles I've read as to all the effects of and pieces that affect the housing market here, and where this author believes it's going to go. So are we headed into another real estate bubble crash? Those who say no see the housing shortage is real, while those who say yes see the demand as a reflection of the Federal Reserve's artificial goosing of the housing market and its unprecedented purchases of mortgage-backed securities and easy money financial conditions. So yeah, when things are good, the Fed's buying the MBS, they're buying mortgage-backed securities. Okay, interest rates are low. The encouragement is to buy. Therefore, where people are overbuying or maybe putting themselves in financial positions they shouldn't be in. All right. So demographics and housing do not reflect a housing shortage nationally. I've seen a couple articles about this now. So we always say there's low inventory. Well, maybe it's not necessarily across the board, just maybe in certain locations. Though there could be some scarcities locally, of course. Another factor such as thousands of units being held off the market as short-term rentals or investments by overseas buyers who have no interest in renting their investment dwellings. So it's almost like, we've got other applications now in the housing industry. We've got increase in short-term, increase in investor model type things. So that they're buying the inventory that's there, but they're not allowing people into those homes or making them rentals or keeping them off the market. So again, basically on a per capita basis, housing has reached the previous bubble levels. That suggests housing shortages are artificial or local, but not structural, which I find is really interesting. So this is a cool graph, and I didn't, basically this is the median price point. So we talk a lot about Case-Shiller, and we look at the Case-Shiller index, and we go by that number as kind of like the be-all, end-all of what's happening in the marketplace. I look at median home price because every month NAR, the National Association of Realtors, does produce the median home price, and that's obviously gone up every month. But if you take a look at, so this is actually a median sales price for new homes. Interesting how when you look at this, you can see where the first housing bubble was, then it crashed. Then he's actually calling that we had a second housing bubble in 2018. And then, of course, it kind of crashed a bit because we had a slowdown, and then we had a little bit of interest rate increases. Then we had COVID hit, and then now we've seen an exponential rise. So he's calling this the housing bubble 3. So I guess I'm behind the times because I'm still housing bubble 2.0. I'm not housing bubble 3.0. So anyway, I just find it interesting that the median sales price of new homes, you can see how that's played out. They've had 3 different peaks right here. And again, the latest run has been exponential increase in value, which is causing problems. Now, of course, then we'll have a big drop off there. But interesting to see how that's kind of played out. Now, I can tell you in that 2018-19 is kind of when I started doing my videos. And I know that I was seeing on the foreclosure data and stats in our area and rest of Florida, I was seeing an increase in volume there. So kind of when that was happening, that's why I like this graph, because that's where I was going, ooh, things are changing. And had we not had the COVID constraints and these moratorium stuff, we probably would have had some problems earlier on or we would have had a softer, we would have had more opportunity for cheaper priced homes had the market been, I guess you could say, been able to naturally correct itself, or naturally cheaper priced properties could have come back into temper what we have right now. But that didn't happen. So obviously we had COVID, and we had moratoriums on both the eviction side for rentals and the foreclosure side and the foreclosure eviction. So there's where we are today. We've had an increase in price points on the existing homes and in the new homes, and now we're rolling into the foreclosure crisis coming up in the next little while here. But very interesting to see how this kind of plays out. Now, ultimately, in the end, when you start taking a look at this, there's some really good points that this guy's making in his article. And again, I suggest that you take a look at it. So ultimately, he's saying here is that few believe cities can unravel. But remote work, geographic arbitrage, tightening credit, rising crime, the decline of commercial real estate, the end of massive stimulus, scarcities, the madness of crowds, the decline in civic services and amenities, and an insanely high cost of living all have consequences and second-order effects. But what were beneficial synergies have become fatal synergies as dynamics reverse and begin reinforcing each other. So let's put this all together, he's saying. The cycle of declining interest rates and inflation has ended, and the cycle of much higher interest and mortgage rates and inflation is beginning. Higher mortgage rates will depress housing prices, as only the highest income households can afford today's prices once mortgage rates rise, which is true. The decay of urban finance and quality of life will accelerate as stimulus ends. Credit dries up and inflation decimates disposable income. So a couple of years when we would get stimulus checks and this and that, that wonderful. You don't have to pay your mortgage, you don't have to forbearance or your rent with the moratorium and things like that. People had disposable income and they could mess around. They paid off credit cards, they did crypto, they bought vehicles. Whatever you wanted to do, you could do because there was no consequences to what was going to happen. And guess what? All that money's kind of dried up now. So the stress of trying to make enough money to afford high costs of cities' suburban living as the real estate bubble pops and the benefits of city living decline will burn out increasing numbers of people who have no choice but to find more affordable, more secure, and more livable places. So D, while the wealthy have already secured second and third homes in desirable towns, there are still opportunities for lower cost, more secure residents in the rural areas. So it's pushing people out. So we're leaving urban, leaving suburban, going to more rural, where we're finding quality of life and maybe work remotely and much cheaper properties. This migration, even at the margins, will further depress urban housing prices and push prices desirable in rural locations. Push prices in desirable rural locations higher. Okay, so ultimately you're seeing a shift. So the big cities, the big locations are going to have a decrease, and the rural locations will probably see a surge, and they're seeing it right now, and that might continue. If this migration will have regional, ethnic, and cultural variations. For example, some African Americans leaving the upper Midwest are finding favor in communities in the South where family, church, and cultural ties beckon. So yeah, people are going to go where they feel more comfortable. And you know what, like as I said before, it's kind of like our housing has become a commodity, right? So when I said a few videos ago that the American dream is dead, it's because now it's an asset class. Our home's an asset class. We don't call the home, we call it an investment, even though it's your primary residence. So that's sort of, changed what it was 10, 15 years ago. So what we're seeing now is people going, okay, I've had enough of this rat race. I had enough of wherever I live, whether it's taxes, politics, commuting, schools, cost of living, whatever that is, people are getting tired of it and they want to enjoy life for a change and can maybe de-stress. So that's where we're seeing migration going to different locations. They call this geographic arbitrage, which means earning money remotely in high-wage sectors while living in some places that's low cost and secure. So it's always, again, going to the Silicon Valley, the people that work for the tech companies, Google, and Apple in those locations. They're making big time money, but they're also paying huge proportion of their income in local rent and housing. Well, if they move away, they've got this great salary. If they can work remotely, they're making their money last farther. Now, of course, the flip side is that eventually, I'm sure that all those corporations are going to, okay, well, if we're allowing you to remotely work, we can't pay you the Silicon Valley wage. That's probably going to have to come to realization at some point in time as well, too. And basically, though monetary inflationary forces will pop housing prices based solely on low mortgage rates, this doesn't mean that housing everywhere will decline. As burned out urbanites seek lower cost, more secure and livable places in rural locales, homes in desirable towns and small cities could rise sharply because they're starting from such low levels. So yeah, we can see those locations going up. If urban areas decay rapidly, housing prices could plummet much faster than most people think possible. And this is interesting because, we don't talk about this. We're purposely told not to talk about it, or you're purposely not shown the information that we could talk about. Obviously, I talk about it. So the whole idea is so you're not aware of what's going to happen in the future, which is not really a good thing. So when cities lose employment, tax revenues, because that's going to be a big thing too. Tax revenues are major, and if they lose tax revenue and desirability, they can go down fast. Property values can fall in half, then by 90%. How is this possible? Supply and demand. Demand falls off a cliff. There won't be buyers for thousands of homes that come on the market all at once. This is just like a stock market, which buyers disappear. No one wants to buy an asset that's rapidly losing value. So these are all really good points about how this market's going to shake out. And you can see how it's all, there's not just one factor. There's many factors here that are at play here. But in the end, when you add them all up, it's pretty substantial. Now, this is really interesting, okay? How low could housing go? As explained above, there will likely be a very asymmetric declines and increases in housing valuations going forward across the board. Okay, but on a technical analysis level, we can anticipate a general decline to previous lows. First to the 2019 lows, then to the 2011 lows. Okay, so what he's actually saying here is that it's almost like we're going to see a two-tier decrease. We're probably going to get our correction where we go, okay, well, we got to have some stuff coming off the board. We got to have some price decreases because of mortgage rates and things like that. It's going to be the first shakeup, I guess you could say. Then we'll see the back down to the 2011 lows when more foreclosures come on, more distress comes on, more things start to, the ripple effect kind of manifests and opens up. So it's almost like a two-prong, like bang and then bang. That's how I look at it. So some analysts believe inflation will funnel capital into housing as investors seek assets. They'll go up with inflation, but this is a murky forecast. The bottom 90% of American households have already priced out of coastal housing, so inflation only robs their wages of purchasing power. They don't have any hope of buying a house. Simple as that. Ultimately, all these swirling currents will affect housing valuations in different places differently. Some areas could see 50% declines, while others see 50% increases, regardless of mortgage rates or Fed policy. So I guess it depends on where the wind blows and where people are going. What will become most desirable is a low cost of living, security, and livability, which includes community, reduced dependency on long supply chains, and local production of essentials. So people want quality of life. They don't want to have to deal with commutes. They don't want to have to deal with crime, stuff like that. They want to enjoy life, have the American dream, let's call it that, and just live and just be a regular citizen and pay their mortgage and live happily ever after. So it's interesting that we are all prone to believing the recent past is a reliable guide to the future, but in times of dynamic reversals, the past is an anchor thwarting our progress, not a forecast. All right, very interesting. So I'd like this article because it's a different perspective. It certainly resonates with me personally. It shows that there's lots of factors at play here, which is interesting. And you know what? I was thinking about this, and I'm not taking credit for it, but I've already thought of a two-tier hit because the first tier would be with mortgage rates, and then the second, and that's going to hit us first as it's doing right now. So there could be some drawback and some downward pricing based on how the mortgage rates have the effect. And then by the time that's kind of gone through that sort of portion, then the foreclosures are going to be here and it's going to draw down everything else, you see. So really seems to make sense. I do think this is a really good article, but there's a lot I didn't go into because it would take another hour. So definitely read this because I think it's probably the best one I've seen to date based on what's happening in the marketplace and what could happen. And again, no, he's not saying that it's across the board. Some markets will do well or better than others because of the shift in where people are migrating. But in the end, I think we're going to see this two-tier, bang with the first bit and then a big drop with the second bit as the foreclosures come into play. So very interesting. Keep that in mind. All right, guys. So again, Thursday, May 5th, 8 o'clock p.m., first call. Distressed Property Architect Program. Jump on it. I'm trying to reach out to as many people as I can. I know I'm back and forth with calls and sending emails and stuff like that. We got a lot of good stuff to talk about. The things I'm talking about are pertinent to you buying a property in this market, to you earning income in this market, to you becoming a real estate professional in this market, okay? That's the whole point. Whether you buy it cheaper or you're making money from it, it's an asset. Might as well use it because everybody else is, right? Might as well play the game as far as I'm concerned. So, pick and choose whether you want to live in it or you want it to earn income or whatever. But the whole point, though, is that these are market areas that aren't really being looked at by the masses. It will come once things shift a bit. Suddenly people will start to focus on all this again and be very competitive. So now's the chance to get in early to learn this stuff. And as I say, I'll talk about things that I can't talk about on this channel, and I'll get really into it where you'll hopefully be enlightened as to what's going to happen and how to prepare for this. Again, I have a game plan for myself. We know that we face the lenders, we face the court systems, we face the Fed, we face Wall Street. There's a lot of stuff happening out there, mortgage companies, the whole bit, a lot of moving parts. It's really trying to maintain your level head and kind of work between the seams to get your hands on properties and get your hands on good deals without raising flags and letting people know what you're doing. Simple as that. All right. So anyway, reach out to me again. You got a couple days to do that. Okay. Let's get on the horn and get going here. Why do you want to do it? Because you get deals like this. Yes, this is a great deal. This is a very good deal. My client's very happy that we were able to work this out for him. And stuff's out there. And if you saw that example I put up about all these legacy foreclosures, well, no one's going to buy that property for $815,000. So it needs a short sale. And that's why these deals are going to be available, or the opportunities are going to be there. They're not all going to disappear into the la land if you try to go after them. All right. So once again, reach out to me. There's my email. Once again, thank you for the views, likes, comments. Please share the video with your family and friends. Subscribe if you're not a subscriber, and reach out to me to get yourself going on my new programs. All right. Take care, guys.